All right, welcome back to Daily Market Narrative, your go-to source for making sense of the madness that is the financial world. I'm Dave, and today we're diving into a narrative so prevalent it's practically tattooed on the market's forehead, the AI-fueled tech earnings juggernaut. Now, if you've been anywhere near a financial news outlet, you've heard the gospel. The bull case is, frankly, pretty compelling. Corporate earnings, especially from those behemoths we affectionately call the Magnificent Seven, are absolutely crushing it. And the secret sauce? Artificial intelligence. Companies are not just talking about AI, they're delivering the goods, showing robust quarterly results and flashing optimistic guidance that has investors practically doing cartwheels. This isn't just hype, folks. It's tangible profit growth, driving market resilience, and pushing indices to some rather lofty heights. Pair that with the growing confidence in a soft landing or even a no landing for the economy, and suddenly those nagging worries about the Federal Reserve's higher-for-longer mantra just seem to fade away. Investors, bless their optimistic hearts, are happily prioritizing earnings momentum and the transformative potential of AI over the slightly uncomfortable reality of borrowing costs. It's a beautiful, profit-driven narrative if you're wearing rose-tinted AI-powered goggles. But before we all start buying robot-shaped piggy banks, let's inject a dose of reality, shall we? This narrative, while powerful, isn't without its potential Achilles heel. That persistent discussion point about the timing and magnitude of Fed rate cuts, it's not just background noise, it's a source of real volatility. And that increasing confidence in a soft landing? Well, confidence can be a fickle beast, especially when the economic data decides to throw a curveball. What happens if this AI enthusiasm becomes a bit too concentrated, too reliant on a handful of megacaps? Or if those slightly higher for longer borrowing costs start to bite harder than anticipated, perhaps chilling that resilient economic growth? We're essentially betting big that AI can continuously defy gravity and that the Fed won't accidentally trip us into a harder landing. It's a powerful story, but one built on a very specific set of assumptions, and as we all know, assumptions in the market often come with a side of unforeseen consequences. Speaking of defying gravity, let's do a quick technical check-in on the SPY because nothing says trillions of dollars at stake like a few squiggly lines on a chart. According to the technical wizards, the SPY is currently in a rather healthy uptrend. The key here, apparently, is that the support levels of 645 and 620 need to hold firm. As long as those don't crack, the path of least resistance is up, with a target of around 670 firmly in the crosshairs. So, for all you chart enthusiasts out there, keep an eye on those levels. If they break, well, then those squiggles might start telling a different, less upwardly mobile story. Now let's pivot to the headlines that matter, because while AI is fantastic, the rest of the world still insists on happening. First up, Bloomberg dropping a bit of a mixed bag. Watch U.S. economy. Core CPI rises, jobless claims jump to 263,000. So what's cooking? Core CPI, which strips out the volatile food and energy, has risen modestly for a second straight month. That's your persistent inflation signal right there. But then, weekly jobless claims have jumped to their highest since June, suggesting a labor market that's suddenly feeling a bit wobbly, perhaps hinting at more layoffs. The market impact here? It's a classic Fed headache. Rising inflation and a softening labor market complicates everything for Powell and his crew. Expect increased volatility as traders try to figure out if the Fed will lean towards fighting inflation or propping up jobs, or somehow, impossibly, both. Next, a direct reaction to that. CNBC reports, 10-year Treasury yield drops to 4% after inline core inflation jump in jobless claims. The yield on the benchmark 10-year Treasury has fallen to that nice round 4% number. This tells you the market is increasingly confident the Fed will cut rates, with some analysts already penciling in a few cuts for 2025. Lower yields mean cheaper borrowing for businesses and consumers, which should, in theory, stimulate the economy and be a boon for growth stocks. But let's be honest, it also signals underlying concerns about that weakening economy we just talked about. So, a win for your high-flying tech, maybe, but perhaps a yellow flag for the overall economic outlook. Speaking of high-flying tech, Oracle just had a day for the ages. Oracle stock gains 36% to post best day since 1992, adding $244 billion in value, according to CNBC. 36%, that's not a gain, that's a moonshot. What drove it? Gobsmacking demand for its cloud services, especially for AI infrastructure, multi-billion-dollar contracts, and a bullish outlook for cloud revenue. The market impact is clear. AI is fueling a gold rush for infrastructure providers. This is a massive vote of confidence for tech companies building the picks and shovels for the AI revolution, and it will likely spur even more investment and competition in the cloud and AI sectors. Everyone wants a piece of that gobsmacking pie. Now, a story that always gets the market a little antsy. CNBC with Trump Fed nominee Stephen Miran advanced by Senate Banking Committee tees up final vote. Stephen Miran, a Trump nominee, is moving closer to a spot on the Federal Reserve Board. While he says he'd taken unpaid leave from his current White House role if confirmed, Democrats are raising eyebrows about the Fed's cherished independence. The market impact? Any perceived political influence creeping into the supposedly apolitical Federal Reserve can unnerve investors. The Fed's independence is key to its credibility, and anything that chips away at that introduces uncertainty into future monetary policy decisions. Across the pond, Bloomberg tells us, France stalls the ECB's perfect soft landing. While the specifics aren't detailed in the snippet, the implication is that economic or political developments in France are complicating the European Central Bank's efforts to navigate a smooth economic transition without a recession. For European markets, this means more uncertainty, potentially impacting the euro and bond yields. If France, a major Eurozone player, is throwing a wrench in the works, the ECB might have to adjust its strategies, perhaps with more aggressive or prolonged measures. Down in Latin America, Bloomberg reports, Mexico tariffs give Japan's car makers an edge over Korean rivals. Mexico has slapped new tariffs on Asian imports, and because South Korea lacks a free trade agreement with Mexico, unlike Japan, Korean cars are suddenly more expensive and less competitive. This is a classic trade agreement wins the day scenario. Expect a shift in market share in the Mexican auto industry, favoring the Japanese and impacting the strategies of Korean manufacturers. It's a stark reminder that trade policies still have real-world, bottom-line consequences. Jumping back to geopolitical risks, Bloomberg has NATO working on defensive measures after Poland drone incident. Russian drones apparently entered Polish airspace, prompting Poland to activate NATO's Article 4. They shot down some drones and are now asking for more air defenses. The market impact is, unfortunately, a heightened sense of geopolitical risk in Europe. We're talking increased defense spending, which could be good for defense stocks, but also broader market uncertainty as the specter of conflict looms larger. On the energy front, OPEC still sees tight oil market despite supply increases, via Bloomberg. Even though OPEC Plus has agreed to pump more oil starting next year, they still see the market as tight. This is a bit of a head-scratcher when some forecasters are warning of a looming supply surplus. OPEC's stance here could keep oil prices volatile or elevated, impacting energy sector stocks and, of course, global inflation. It suggests they're balancing increased supply against strong demand or other geopolitical factors, so don't expect a smooth ride at the pump. Another Fed-related legal tussle, also from Bloomberg, Trump asks appeals court to let him oust Fed's Lisa Cook. Former President Trump is challenging a lower court's block on his attempt to remove Federal Reserve Governor Lisa Cook. He's citing allegations of mortgage fraud, while Cook argues her dismissal is without cause, challenging presidential authority. This is another layer of political uncertainty over the Fed's independence and stability. Such a direct challenge to the central bank's autonomy could unsettle financial markets and impact confidence in the impartiality of monetary policy. It's a soap opera we don't need in our monetary policy. Moving to corporate strategy, Bloomberg reports Novo CEO calls workforce back to office for obesity drug battle. Novo Nordisk's CEO is mandating a return to the office. Why? To foster collaboration and accelerate their efforts in the insanely competitive obesity drug market, specifically against rivals like Eli Lilly. The market impact? This could boost Novo Nordisk's efficiency and innovation in the short term, strengthening their competitive edge. It also highlights the fierce competition and high stakes in this rapidly growing pharmaceutical sector, perhaps even signaling a trend for other companies in high-stakes industries. And finally, something that typically makes shareholders very happy. Bloomberg's headline, JP Morgan sees record U.S. buybacks jumping by another $600 billion. JP Morgan analysts are forecasting an additional $600 billion in U.S. share buybacks this year, on top of what's already a record-breaking pace. This is driven by strong corporate confidence, robust earnings, and plenty of cash from big tech and financial players. The market impact? Buybacks are generally very supportive of equity markets. They reduce outstanding shares, boost earnings per share, and signal bullish sentiment. But it also raises the perennial question. Is this the best use of capital, or are companies just engineering their stock prices rather than investing in long-term growth? Something to ponder. Now, let's take a quick look ahead at the economic calendar, because the market always has another set of data points to obsess over. This week, keep your eyes glued to the labor market. We've got initial jobless claims and continuing jobless claims coming out. These are critical for understanding the health of the employment picture and how the Fed might react. A big jump could signal a weakening economy, while a steady number might calm some nerves. Then, the big one. We have a deluge of inflation rate data, including core CPI MOM year-over-year and the overall CPI MOM year-over-year. This is the Fed's prime directive, so any surprises here will likely dictate market movements and interest rate expectations. Also, keep an eye on the Fed balance sheet. It gives us a glimpse into the central bank's liquidity operations and overall monetary policy stance. And for all you aspiring homeowners, the latest 15-year and 30-year mortgage rates will be out, giving us a pulse check on the housing market. So, there you have it. The market is currently riding high on an AI-powered earnings wave, hoping for a soft landing. But underneath it all, there's a swirl of conflicting economic signals, geopolitical tensions, and political skirmishes vying for our attention. It's never boring, is it? As always, stay informed, stay diversified, and I'll see you next time on Daily Market Narrative.